There are moments in financial history when the ground shifts under your feet, and most people never notice until it's too late. This week that just passed, Netflix made a move that shook Hollywood. This week that's coming up, the Fed is set to shake the market with a rate cut. But also I dug deep and found out that China and Argentina really flipped the global soybean market, and lithium became the new gold for the AI world. This video isn't just about one story, y'all. It's about connecting the dots between them all, and why I think that 2026 might be one of the most profitable years or one of the most dangerous years that we can invest in. And in a few minutes, not only will we go through the charts, but I'm going to also show you why Netflix truly is positioning itself to rearrange Hollywood. So before we get into this video, man, make sure you like, make sure you subscribe, and make sure you share, because we got a lot to talk about. This is going to be kind of a long video, so I'm just preparing y'all for it. So get your popcorn, get your pen, get your pad, because trapper attire is required. Let's go. Let's just start with the colossal move that Netflix just made. Let me start there, because that's a shocker. Well, we know that Warner Brothers have been trying to sell it. Just a company that's been crippled with so much debt. Now, Netflix outbid Paramount to buy Warner Brothers. Now, the thing about that was, Warner Brothers offered a deal. And the deal was $30 a share, right? $30 a share for 2.6 billion shares, right? Gave them about a $78 billion valuation, which is not bad. But Netflix said, no. Now, what Netflix decided to do was, they decided to come in with a $23.25 per share cash offer, plus a $4.50 stake in Netflix stock, which gave it a $72 billion equity valuation, but it gave it an $82 billion enterprise valuation. Either way, nobody was happy about that but Netflix. And the thing about that was, Paramount wanted to buy the whole company. Netflix, well, they just bought about 3/4 of the company. But think about it. It's not just one division. It's not just one library. But honestly, the studios and future films as well. So let's just break it all the way down so you can really see the numbers. So Paramount offered $30 per share, valuing Warner Brothers at about $78 billion for the whole company. Netflix offered them $23.25 plus $4.50 of Netflix shares, which gave them an $82 billion enterprise value. But here's the assets that they get. HBO, Game of Thrones, Harry Potter, HBO Max, the whole DC universe, Warner Brothers Film Studio, the Cartoon Networks, Lord of the Rings, Friends, The Wizard of Oz, Flintstones, Gremlins, and a whole lot more. Let's go a little further into this. This isn't a library acquisition. This is a cultural consolidation. This is them saying, yo, we trying to wipe all y'all out. And this is something that we've been seeing coming for a long time. Netflix is really saying, we not competing with Hollywood no more. We are Hollywood. Now, here's where the story gets kind of wild. The stock really fell on that acquisition. While most people thought that would have went crazy, the stock fell. Well, let me break that part down. Netflix is really taking on a lot of debt because Warner Brothers have a lot of debt. And so when you acquire a company, you got to take the debt on it. Now, regulations are going to be really strict on this. And here's the reason why. This deal could take between 12 to 18 months so it's not really Netflix's just yet. And Warner Brothers are really upset about this. They really actually about to put a suit in and said that they aren't being justly considered. Right now, we know that Netflix has been putting a lot of pressure on just the streaming world. They are the king. The pandemic, we saw the race between Disney, but then Netflix just said, no, nobody not going to put more content out than us. Now, the only person that does put more content out than Netflix is YouTube, and that's because we put out the content, right? The thing about that is, there's an old guard that's been in place. The old people who've owned Hollywood and owned all the media for all of this long time, where your time is up, man. Because as we go a little further, we start to realize that Netflix, and we'll dig deeper into this, like Netflix actually makes more money in revenue than like the whole movie industry combined. It's putting itself in position to control more than intellectual property. It's putting itself in position to just be the king of media. So let's just think about it. Netflix revenue came in at $43 billion. Global box office came in at $30 billion. AMC theaters is $4 billion. Netflix is bigger than the entire theater industry combined. It's outperformed every media stock for years. Not to mention, Netflix has a pretty good PE ratio. Yep, there's more. That PE ratio is a premium. So all the OGs really don't like this YN. Well, whoop-de-doo. So the OGs don't like it. So purchasing Warner Brothers really is crushing the old guard. And it's only a matter of time before Amazon buys another one of the OGs because simply they just can't compete. They hold too much debt. And these new people, these new companies like Amazon, these new companies like Netflix, these newer companies in the media space, well, it just can't. Even think about Comcast, that where we watch CNBC on, they got so much debt. And so people are really just like, bro, we're not even buying what they have. Now, the thing about this is, the big deal about this is this could definitely fall under antitrust law. Now, what is antitrust? It's just saying that you own too much of this, right? And it always happens. They do it with Facebook. They do it with Google. They do it with all of the big dogs. The thing about Netflix is, like, when you think about Facebook, when you think about Google, when you think about Amazon, when you think about Apple, these aren't old business models. You got to think media is a old business model. So a lot of those rules have been grandfathered in, right? A lot of those politics, a lot of those names, a lot of those families, they've been grandfathered in. So they're going to protect that with their life. Whereas with Apple, Meta, Amazon, these are brand new industries when you think in the totality of things. So they was really shaping these up as they go. They were trying to build the rules as they go. And before you know it, they got too big before they could put the rules in. So this is why companies are always getting sued for antitrust and monopolies. Well, it's just too big. It's really just a free way for the government to get a check. But with media, it's a little bit different. It's a little bit tricky. And the reason why it's a little bit tricky is because it's a lot of old money involved. So I do think that investors sold out of the stock because they saw, yep, I see what you're doing, Netflix, and this is phenomenal. But at the same time, this could take 12 to 18 months. And if it doesn't even come out, then people don't just want their money tied up. So a lot of the big investors got out of Netflix because they just didn't want their money tied up in that. Doesn't mean that Netflix can't, take this on and kill it. I definitely think they can, but it's just going to be one of them ones. It's going to be a slow grind. The stock going to kind of be just getting beat up and ground up. It's going to do something, but I personally don't think it's going to do a lot. Plus the stock this split, but let's go in the chart and look at it. We're going to start off right out the gate, just marking some things up. So we have the 20-day sloping down. We have the 50-day sloping down, and that's on a weekly. So we definitely don't like that, right? Come out right quick. We'll just boom right here. I think these are two interesting spots for it. And let's just see how that matches up for us on the daily. We come here on a daily, make that look good. We see that. But then let's just get a little bit linear right quick. All right, let's get a little linear right quick and look at this on a daily. This would be really good for us to look at, just to look at an overall vision of it. It's going to be important for us to look at it from a bigger picture because this trend line really going to help us out. Let's connect here. That about works it. Just so we can get a really clean touch on it. And as we can see right here, as I'm looking at Netflix, I'm just like, dang, y'all know, because I was locked in with Netflix. You feel what I'm saying? And so here we go. We see our trend. We see a clean trend line right here. Our trend line is touching. Boom, boom. We come through. And so as we can see, we see how Netflix did something that was really good right here. Notice how it bounced off that trend line and then it shot up. And then once the news came in about the acquisition, it just fell straight down, man. And so now it's below that trend line. And that's a major point because we see that this trend line is sustainable for a long time. So it now done bounced below that trend line. So this is why I can say, yeah, I can see it coming to 193. And then from 193, I don't think it just crashes out. But if it breaks 193, I wouldn't mind shorting it from 193 all the way down to $85. I wouldn't mind that play. I mean, it was already in the downtrend when you look at it from, you throw your fib up there. You throw your fib up from swing high to swing low. I mean, it's under 780, under that 786, so we would see it's under the 20, it's under the 50. See if it can get some bounce on it. Maybe, I mean, that is the swing low. Just from low to high, I mean, swing high to swing low, we see where it's at. I can see it making a bounce up, but I don't see it getting under that halfway or that 618 for a time right now. Could be wrong. You never know what the market doing. I'm hella bullish on Netflix. I think that's a good deal that they did. I just think it'll take a little time for them to shake back, and now they underneath the trend line, which is, it's like, damn, I don't want you to be under there. Then you got to see it's touching that. So, yeah, I know for sure. I think it can go to $93 for sure. If it breaks 93, then we really got a situation. I think it could go from 93 to 85 for sure. So that's just what I got on Netflix. And it's hard for me to say something like that just because how much money I made on Netflix. So, I mean, we ain't in love with none of these stocks. We just want the ones that's going to give us the profit. So let's keep going, y'all. Now that we got Netflix out the way, let's talk about how rate cuts, global power, and soybeans go together. That's right. All right. So as we head into this week right here, here's what we do know. There's a rate cut on the line, y'all. And what we know is there's probably about a 0.25% rate cut on the line that the market is kind of expecting already, right? Now, the Fed has already projected, the Fed has projected that in September that we will have a 3.6% Fed fund rate by the end of the year. Now, the quarter cent rate cut puts us at 3.5. Now, that aligns with their plan. Now, you're thinking that the market really should rally. Well, the real question is, at this market, it's going to be two things. One, is the Fed going to turn the money printers on? And two, what is going to happen in January? That's right. What is going to happen in January? Now, here's why I say what's going to happen in January. So here's what we know. We got a rate cut meeting coming up really, really soon, couple of days. But let's go a little further. So as of right now, we got like an 86.2% chance that there's going to be a rate cut. Now, here's what we know. We know for a fact that they already told us that they was going to cut rates. They told us what was going to happen by the end of the year. So I'm going to be real with you. I don't truly think that the market is going to rally behind that. I think that that's already priced in the market. I think the real culprit is this right here. January. I think the real culprit is January because as of right now, the January rate cut right now is at 24.8%. Now, let's just dig a little deeper into that and let's just see what does that mean for everybody. What that means is if we can get back-to-back rate cuts and the market is optimistic about rate cuts in January and the market is optimistic about quantitative easing. Now, we know that quantitative tightening, the Fed locked up the puppies, right? In December 1st. They said, nope, we not tightening no more. And then remember in the last week's show, we talked about another Fed governor saying that what? I think we should start what? Increasing our balance sheet, which means the Fed needs to start buying more U.S. treasuries, right? That's how we pump money into the system. So if the Fed signals slower cuts, then the market dips. Steady cuts, the market pop. Fast cuts, you get a euphoric rally. More money plus cuts, we get a Santa Claus rally. We get the rally, the Santa Claus rally, and we go into January, print in money. Now, we know that Kevin Hazlitt has been predicted to be the front runner for the Fed. Now, the thing about that is, the markets really I don't know how the markets feel about that because I saw some dope headlines, saying that, he's going to cut rates because of Trump, and that could be bad for the economy. And so the bonds, if you notice, the bond market has been ticking up because the bond market is really the real market. The stock market gets all the glam and the glory, but the real money is in the bond market. Now, of course, we know he's going to cut rates, and him cutting rates because Trump wanted him to cut rates, that's what he's going to do. He came out and said he's bullish on the market. He's bullish on growth in the economy. He said all of these things, and these things are really bullish for the market. And that's what we want to see when it comes to getting money. We want somebody in there that's going to help us get money, but at what costs. Now, we know right now that the Fed is in a blackout. It cannot speak because every time they speak, the market goes one way or swings another way. And so because they're in this blackout moment, we don't really get to hear nothing about the Fed. And what we know is Jerome Powell talked last week and he did not mention anything about rate cuts, nor what he thinks about the economy. Now, that is real because it keeps us in the perspective as investors to say, what's next? Because the market is always looking for a catalyst to go forward, right? All right. Now, soybeans. Let's talk about that. This is going to be important. Because when I uncovered this, y'all, my mind just went, whew. So let's break it down. The media told us that the soybean crash was because Trump did what? Mentioned the tweet. What soybean crash are you talking about, Trap? I'm talking about October 10th when we got the Trump tweet. Remember I said the Trump tweet. As a matter of fact, let's just go to the chart. Remember when the market sold off on us? Right? Remember when the market sold off on us and we was like, man, what's going on? What's going on? Well, that was this right here. That was the Trump tweet right there talking about soybeans. That was the first tower of the Twin Towers. And we saw it on the SPY and we saw it on the Qs. Right? That day right there is the day that we talking about. That was the Trump sell-off when he talked about the soybeans. That was the one that put us in a situation that we didn't know what that was coming from. We just watched that huge red candle fall on that chart out of nowhere on a perfectly good trading day too. But here's what really happened. China buys 50% of U.S. soybeans. That's about $13 billion a year. Trump criticized China publicly. China retaliated, cutting U.S. soybean demand. China pivoted to Argentina and Brazil. U.S. farmers, they got hit really, really hard. So here's the part no one saw coming. Now, the U.S. loaned Argentina $20 billion. Why? Well, because China went to Argentina and got their soybeans, right? Argentina is the third largest soybean provider after Brazil and after the United States. Well, it wasn't charity. So now we understand that Argentina has really been having a hard time with their economy, a really hard time. Now, this wasn't generosity. This was not charity. It was strategy. So the Chinese yen is competing for global domination, but it doesn't have the power that the U.S. dollar has. And I know y'all gonna say, Trap, the American dollar don't got no power. Well, it's still used 49% of the times on all transactions around the world. It still is used to buy petroleum and oil outside of China and Russia because it's called the petrodollar. So what America did was they said, okay, let's give them what's called a currency exchange. So we gave them $20 billion in US dollars. Then they gave us $20 billion in pesos. Now, what they have to do is they have to pay us the $20 billion back in American dollars with interest. What does that do? It makes Argentina look at America like, yo, y'all really our allies. I appreciate that. What it also does is it helps America get another ally and it bumps China off just a little bit more. But it gets deeper. Argentina is part of what's called the Lithium Triangle, home of over 50% of the world's lithium reserves. Lithium is the battery that powers electronic vehicles, robots, AI servers, data center energy storage, drones, and satellites. Whoop-de-doo. So, that means America was kind of playing chess on that move. But here's the truth. You cannot run AI without electricity. You cannot store electricity without lithium. China was actually courting Argentina. Because what did China do? China said, hey, we're going to loan you $5 billion and we're going to buy some soybeans from you. But the U.S. saw that was coming and they blocked that alliance. And then Argentina could buy commodities from the U.S. They can stabilize their economy with the currency. They can partner with U.S. tech and mining. They can buy stuff from other people around the world because the U.S. dollar is strong. So it gives them leverage. So that's the power of the dollar. Now, lithium isn't a commodity anymore. It's leverage, real leverage. And it really decides which countries dominate EV and manufacturing. Which companies dominate robotics? Which governments control AI infrastructure? Which currencies stay relevant? Argentina, Chile, Bolivia, they hold the keys. That is the lithium triangle. And now America is deciding to do what? They're buying direct stakes in what? Lithium Americas, MP Materials, Valcom Elements. This isn't investing. This is a resource warfare. Lithium is the new oil. AI is the new industrial revolution. And batteries are the arteries. But let's go a little further to make that make sense. Last week on the Sunday's Breakdown, we talked about the Genesis mission, the America's AI Accelerator, where Trump signed an executive order launching the Genesis missions, a national AI acceleration program. Not a bill for robots. A national transformational strategy. So now it makes even more sense why he would step up to Argentina and say, hey, here's 20 million and we may have here's 20 billion and we may have 20 billion more for you. AI is hitting the wall, not because of chips, but because of electricity. All servers. AI is hitting the wall, not just because of chips, because of electricity. AI servers are eating power grids alive. In 2025, 600 terawatt hours. By 2030, they're saying 1,000 terawatt hours. By 2033, 2,500 terawatt hours. That's multiple countries worth of electricity, y'all. So the U.S. is securing lithium batteries, rare earths, uranium. Lithium for batteries, rare earths for motor magnets and sensors, and uranium for stable base load power. This is chess. And so whoever controls the energy, they control AI. So now we get a chance to see why Trump did what he did. Now, this is chess, not checkers. So I guess the goal is to help Argentina to keep Trump, because China really been playing some good ball. Not gonna lie, they really been moving, and we can't deny that they're a powerhouse. But the yen is not as powerful as the dollar. It's not as trusted. It's not as used so much around the world. That's what gives us leverage. Why? Because America has the reserve currency, and we have the #1 economy in the world. That's right, we have the #1 economy in the world. That gives us some type of leverage. Whether you like America or not, whether you get pissed off about the dollar or not, listen, every country got stuff they're going through, right? But we understand what's happening right here. We understand what moves be getting paid. Now, the farmers are suffering for the soybeans. I'm not going to lie. It wasn't a strong move. But I'm not mad at the power move that they made with the $20 billion to help Argentina, because you got to get at the forefront of this game. Just like China is not letting Nvidia sell their chips over that. They understand. And America saying, yo, we not letting you give them the smartest chips. And China saying, yo, none of y'all can buy Nvidia chips. It's the race to who gets in the front of the AI space. Speaking of AI, let's talk about Meta Surge. Let's talk about Meta Surge. Now, y'all know I have been a bull for Meta, but Meta shocked the markets last week, cutting Reality Labs spend by 30%. What is Reality Labs? For some reason, during the pandemic, Mark Zuckerberg just felt like, yep, we going all in on virtual reality. And before we go further into this video, man, make sure you like, make sure you subscribe, make sure you share this, because I know it's long, but listen, I got a lot to talk to y'all about. So, Meta's cutting Reality Labs by 30%. Now, Reality Labs was their AI world that they want people to get into and all that. And I don't think the world is just ready to do all that. And Mark was adamant about spending money. And in 2021, Mark said I'm spending about $70 billion on it, right? And now the world was like, nah, Mark, you're spending too much money. The last earnings report, they said, nah, Mark, you're spending too much money on that, right? So Mark cut. Now, here's the thing. When he cut, the stock surged. Because Mark said, we're going to focus on AI monetization. We're going to accelerate that. We're going to focus on ad revenue stabilization. We're going to focus on user growth. And we're going to focus on raising guidance. Investors rewarded them instantly. But here's the real story. Meta really removed the biggest anchor. This was the thing that was holding them down. The metaverse burn. Now money can flow through AI. It can flow through data centers. it can flow through model training, it can flow through infrastructure, it can flow through AR, VR synergies. Meta is truly becoming one of the most profitable AI infrastructures, not just a metaverse dream. All right, so let's just look at Nvidia right quick. Let's tap all the way in with it, man. Let's lock all the way in because I know everybody wants to see this big dog right here. All right, so first and foremost, what I'm looking at is, let's get on it. The first thing I'm gonna do when I look at it on the weekly, we're gonna put this structure break on right here. This is important for us to see. All right, we see it tap that. I think my next one would be here at that 167. That's good. I like that. And then my next one would be about here. And the reason why I'm gonna use that one is that candle right there is because this has come off of, again, I like when I see these, it's important to see. After you create that all-time high, coming off that momentum, you create that high, that higher high right here, and then you get that drop, which is kind of textbook. And then once you get that higher low. I mean, you get that, you get that higher low. And then you go there, you create another high. But the problem with why I like this candle here is because you create that high and then you create a high, but then the sellers absorbed all that. So that's a lot of trap buyers right there. And I don't want that. Right? Those trap buyers do get released here, but I'd rather go with this one. So that's my levels right quick when I go look at when I go look at it on, let me use another color right there. When I go look at it on the 1 hour. So that's our weekly. Notice we got our 50-day curved up. We got our 20 days curved up, level above it. Not mad at it. Let's get to our daily. See if if it line up. We want to make sure we on key levels. That's important for us to look at and see. And yep, there go our 66. We like that. There go our level right there. I like that level right there. It's good. Notice that it closed just above it. So I would kind of like inched up just a little bit to give me some more clarity. There you go. I like it there. Because notice it hit here, hit here, hit here. Gap there. So we like it right there. I'm not mad at that. That's perfect for us to look at. All right, let's go back and check it. Make sure we double up. Yep, at the top of that. That's good. All right, so we good there. Notice our 20-day is sloping down. Our 50-day is sloping up. I like that. If I had to look at another level just to be safe on my close, I wouldn't come all the way down here to 166, but I would go here at 174. Why? Because the level has already been obtained. It's already been spoken for. All right, so I don't want to fight for no level that ain't been spoken for already. All right, so I like 174. If it was to come back down from 180, 182. I like it at 174. Not mad at that. But for Nvidia, I'm not gonna lie. What I would needed to do, just being 100% honest with you, I needed to get to that 191. I need to get it above that structure again. Why I'm not worried about this? Why I don't want it? Because once we clear 190, we've gotten over a lot of overhead supply. Now we still got some here, but 190 puts us in a better situation. I would like it at 191. I would like that. Let's look at our 4 hour. Let's see. I would like to get back into that 191. I would see, yeah, all of that overhead supply. I don't like it. Definitely over 191 what I like, because now it's above the 20, it's above the 50. I'm already in one play right now. But above the 50, above the 20 definitely gives me something. So 191, I would love 191, especially off a break and retest, to go back to all-time highs at 212. Get above 191. This ain't much. So let's look at the hourly. Here's what we see on the hourly, right? You kind of got a misalignment, but you see the curve happening on your that. You see it sitting right on a 20, right above that. But if you go back to the daily, you see that huge. So now that shows us misalignment, because here's why. You got our curve up here on a daily. You got a slope down on a 4 hour. You got the 50 and the 20, and on a 1 hour. You see, so you got a lot going on. Again, that's what we call time frame misalignment. I don't want to be no part of when it's time frame misalignment. 191 would give me a better idea of what's going on. You know what I'm saying? I get it at 191. I think we'll have more alignment. The chart will be more smoother. It'll be more easy for me to look at, better for me to execute. So I'm going to stick with that 191 when it comes to Nvidia. Nvidia. So I got one more chart I want y'all to look at. That's CRDO. So we see our trend lines in place. I talked about this last week. It did. So this is my level right here. Right. So that was on weekly. So we see that it did something. And we see this. We had I don't like that. We had that long pin bar right there. Did what I said it was gonna do. So watch this. Let's just talk about this right quick. Last Sunday, which was here, it was here when I talked about it Friday, right? And Friday, last week when I told y'all about, I said, hey, I like this company going into earnings. Look what happened. Monday it did this. Tuesday, had a killer earnings call. Went from here to here. Went from 171 all the way to 200 and something. Killer earnings calls. But look what it did, y'all. It ran back into this trend line. It ran right back into that trend line. Now, here's what I like about it. It ran into that trend line, but watch this. Look at the weekly. We above our, look, what we've been talking about this call. Looking at our SMAs. Look at our SMAs. Only on here. Now, this is why I ain't execute again, because it fell off earnings. We can see off earnings, it fell off, but we had it all the way going into earnings. So what I want to do, what I want to see, I'm going to go back to my daily. What I want to see is right now is at 167. You know, you're going to be like, yo, Try, that's a steal. Right, but if it went to all-time high, at 211, I'll be honest with you. For me, I'm looking at it. I like it. I'm not mad at it right here. I'm not mad at it right there. But this would be my sweet spot for it. Not gonna lie to you. If it can come to 187, no lie. I like it at 180. I like it at 176. I'm not mad, but I want to see it get back on top of that. So if it can get back on top of 187, I like it. Get back on top of 187. If I can get my SMAs, look, it'll put me right on top. It'll put me right back on top of my 20. It'll put me right back on top of that hourly structure. Come on, look at that. I might, you can say go to here, but I landed right in the sweet spot. So I like it right there, man. Right there puts me right back on top of that hourly structure, 100%. I can get right back on top of that. So I'll even go 181. 181 is beautiful. I had it at 187. I would like to take that out, though. I want to take that candle out. So, yeah, I will go with that, man. 100%. If I'm y'all, that's sweetness. That's so sweet, man. You get on top of that, we can go to 200. I like being inside that chart again. So I wanted y'all to see that Credo technology. That's it, y'all. From there, again, yeah, I don't really got it yet. Somewhere anywhere between 187 and 190 is what I like for you to take. 190 would be the safe play. 187 would be kind of like an early entry, but I like it. It will put us above that. And my goal, if I go to the 1 hour, is to get on top of that choppiness. And that's all I want to do. I just want to get on top of this choppiness right here. If I can get back on top of that choppiness right there, it's going to make my 20-day swing up. If I can get on top of that, I'm good. I like it. Let's just go a little further, y'all. Let's summarize what we did. Don't let this moment pass you by. History doesn't warn you twice. This is one of those chapters where investors study years later and he'd be like, yo, I really lived through it in real time. And once you realize that, you realize the opportunities, whether it's the rate cuts, whether it's Nvidia, whether it's Meta, whether it's gold, whether it's Credo, whatever it is, this is a perfect moment for you to get in the game and execute. And so, man, if you like what we're doing here, man, make sure you like, make sure you subscribe, make sure you share this out. There's a link below to jump into our Patreon. Definitely would love for y'all to come get in a group and exercise with us and lock in with us in these markets just to help you navigate the market with more confidence, more safety, and most importantly, so you can navigate without panicking. It's your boy, the Wall Street Trapper. I appreciate y'all. I love y'all. Make sure you like and subscribe. I'm out.